Hey, Gora. Andre, how's it going? Or excuse me, Andrew. Long day.
Hello, hey Noah, doing well. How are you?
I'm doing good. Doing a quick mic check. Make sure I can hear you. Welcome, Whale Coin Talk community. My name is Noah. I'm here today with Andrew Gordon of GordonLaw.eth. Andrew, let's get started by giving our audience a quick background into yourself, your origin story, what inspired you to specialize in crypto tax law, and what ultimately made you take that leap into Web3.
Sure. So again, my name is Andrew Gordon, and I'm an attorney and also a CPA. I did my master's in accounting before I went to law school, and then I passed the CPA exam as well. About 10 years ago, I started my own law firm, actually right out of law school, and the main concentration was tax. I should mention during law school, I worked at the IRS, and so it got me a lot of experience in tax and the things that can go wrong. And I had also done a fraud trial for the IRS while I was there. So out of law school, decided to switch sides and help taxpayers go against the IRS. And shortly thereafter, actually in 2014, we were approached by one of the co-founders of Ethereum who said that he was getting paid magic internet money and he didn't know how to report it on his taxes or if he should report it at all. And back then in 2014, the tax laws were a lot grayer than they are today. And that was really our introduction into the space. I had always been very familiar with crypto. I think I bought my first Bitcoin in 2012. Um, so this was a way to really connect a lot of my interests, both professionally tax, but then also crypto, and years later, then Web3. And I had always been interested in tax because, as a U.S. person, as a resident or a citizen, there are few things that are certain other than life, death, and taxes. And if you can find ways to reduce one of those certainties, right, taxes, you can greatly improve your quality of life overall. And especially in crypto, a lot of people look at crypto investing and think of ways to maximize their crypto gains, but it's often just as effective, or if not more effective, to minimize taxes. So it's a great way I've found to not only connect my interest, but also use the law, use the information that's out there to help myself as a crypto investor and trader, but also all the other people with ways to minimize their taxes. So that's a little bit about me and my story.
So, CPA and a lawyer, you said that you worked for the IRS for a bit. What kind of work were you doing for them?
Sure. So during law school, my 3L year, my final year of law school, I was at the IRS Office of Chief Counsel, which is where the IRS attorneys are. This is the group that handles tax court cases or large disputes. While I was there, I worked on tax fraud cases, and I was involved in a tax fraud trial before I left. So I got to see a lot of how they did things and what would take a case from an audit, for example, to be a fraud case or even a criminal investigation. So I got a lot of insight into that side of things.
Okay, understood. And I'm assuming you can't go, 'cause when you said you've done a fraud trial for the IRS. I would love to know more details, but I'm assuming you can't go into too many details. But really, at a high level, like how does it work? How long does it last? How many moving parts are there? Like, does the IRS usually win these trials? There's so many questions that popped in my head.
Yeah, so I'll give you some information about it. So um, we were going against a taxpayer who was selling cigarettes out of a store, out of a convenience store that he owned in Chicago. But these cigarettes didn't have the appropriate tax stamps. So some of you may be smokers, some of you might have been in the past. Believe it or not, a large part of the price of cigarettes are taxes. And so he was selling cigarettes without those taxes. And not only that, but he wasn't reporting the income from the sale of those cigarettes on his taxes either. So he's kind of double negative. The IRS did a year-long undercover investigation where they were buying cigarettes from him over time to build up the case to show that he did in fact have income, he knew what he was doing, and so that they could have evidence to then take it to trial or to levy a fraud charge against him. So the IRS, they don't move quickly, but they take their time and they build cases, be it an audit, be it a dispute, whatever it may be. Or in this case, it was something very extreme where they're actually going after someone for fraud. But it does take time. The average audit that we've seen, usually 6 months to a year for an audit. And even before that, the IRS may be doing things in the back end to gather information. So it's a time consuming process.
Andrew, have you ever seen or heard of the IRS going after or auditing a high-profile crypto investor, crypto trader, or even going to trial against a high-profile crypto trader?
Sure. So we were the lead defense counsel for John McAfee, which hopefully Noah you're familiar with, or others out there familiar with John McAfee. And he was very, I guess, well known in the crypto industry. Was very outspoken in a lot of ways. He was indicted on tax fraud charges related to not reporting income that he received in crypto payments. The government was alleging that he was working for crypto projects, which we all saw on social media all the time, but that he was getting paid in crypto and not reporting that crypto on his tax returns. And in fact, this was several years ago. The charges were related to 2017, 2018. We were his lead defense counsel. We were looking forward to our day in court. Unfortunately, he passed away, and so we didn't have that to defend his case. But yes, the IRS, and as we've seen, just the federal government in general, does go after large, high-profile individuals for crypto-related offenses. And when it comes to tax charges specifically, it's a fairly easy one in most cases to prove because crypto is crypto. The blockchain exists. You can see the flow of money, or flow of crypto, rather.
And so are they using high tech, or rather high quality chain analytics to identify whose wallet belongs to who? How does it work?
So I could tell you that as a firm, we are deep in the blockchain every day to identify our clients' transactions to generate tax reports. So that's what we do as a business now. Now that I'm on the other side, we help people every day actually report crypto on their tax returns. And I bring this up because as a firm, our staff, we analyze the blockchain, we see entries and exits, we see the flow of crypto, and we are not the CIA, we are not the FBI. But just from the work we do, we can identify most of the transactions, most of the flows, what wallets are potentially our clients or not. And so not only can we do this, but the IRS can as well. They've invested large sums of money into not only software to help, but also hiring staff that is versed in crypto. We have some audits ongoing against the IRS, and the IRS now has a central division that handles only the crypto audits. And that's because these people now speak the crypto language and they understand crypto. So it's not just the everyday field auditor that's maybe been working for the IRS for 40 years and is just getting used to using a computer instead of a typewriter. It's not those people that are handling the crypto audits.
So they're actually hiring people that were potentially working in the industry, are well versed, likely younger, and pretty tech savvy with respect to being able to use different chain analytic strategies to figure out whose wallets belong to who and who to go after in case there's a big case of tax evasion.
Yes, absolutely. In our experience, they are taking crypto seriously. You may have all noticed that after your name and address on the tax return, for a few years, there's a crypto question. It asks a yes or no question. At any time during the year, did you have crypto activity? And it's a little broader than that, but it requires everyone to answer yes or no. So the IRS is taking it very seriously. The news has also stated they're hiring 87,000 new agents, and it's very likely that a large percentage of those are going to be looking at crypto. Why? There exists what's known as the tax gap. And the tax gap is the difference between what the government collects and what they should collect if people actually reported and paid all of their taxes. And that tax gap is enormous and it's growing. And one of the largest contributors to it, according to the government, is crypto. And so it makes sense if you're the government to put more enforcement resources to collect more money from unreported or underreported crypto.
Makes sense. So, Andrew, how have you seen the regulatory landscape? I mean, we kind of touched on this with respect to the IRS, but have you seen the regulatory landscape for cryptocurrencies evolve over the last 5 years? Forget 10 years. Over the last 5 years, with respect to the kind of how clear things are. You know, what's a taxable event? How certain things are taxed, and I want to jump into nuts and bolts here in a minute with respect to like airdrops, DeFi yields, play to earn yields, you know, the crypto to crypto trades, getting paid in crypto if it's a salary, but if it's a token, what happens then? I want to jump into nuts and bolts, but like, have you seen this stuff mature, or rather the regulatory clarity around this stuff mature to a place where it should be pretty crystal on what is taxable and what is not?
I would say the majority of crypto tax scenarios or questions can be answered with the guidance that's already been issued. But there are still many issues, and we could talk about some of them today, that there has not been guidance on. But over the years, and over the last 5 years especially, the IRS has issued several different pieces clarifying tax treatment on many different scenarios. Back in 2014, the IRS generally defined crypto as property rather than currency. So there was a debate back then as to, is crypto actually currency like dollars, pesos, or is it more like an asset or property? And the IRS said it's property, more like stocks, something like that. Not getting into the securities discussion, but that's how it would be characterized. Since then, the IRS in the last few years, 2018 on, has issued a variety of different documents, including an FAQ on their website that has, I think, about 40, 50 different questions and answers, talking about different scenarios like I was paid crypto for services. Is that income and how do I determine it? Or I'm donating crypto to a charity. Is that a deduction? So many of the different scenarios have been addressed. The IRS has also released explicit guidance on airdrops and forks. That was an area that for a while that there was debate. Is this taxable upon receipt or is it just taxable when sold? And the IRS came out and made it very clear that it's taxable as soon as you receive an airdrop or a fork, a hard fork. Whenever you receive any new crypto, generally, that will be considered income at the fair market value at the time that it's received. But that's where some of the nuances come because sure, it may seem straightforward. All right, I get an airdrop or a fork, then I have income. But what if it was locked up? Or what if you don't want it? What if it was a scam? What if, all different scenarios that the IRS hasn't exactly answered. So while they do have painted, I would say, the broad strokes, there are specific situations which still remain gray. But overall, I would say of the different government agencies, the IRS has been the most forthcoming with guidance and being explicit. This is taxed this way. This is taxed this way. Versus some of the other agencies, and one that we see almost every day in the news, the SEC. People are clamoring. They're demanding guidance. What makes a crypto a security versus not? And instead, we're waiting for lawsuits to end to try to, for example, the Ripple lawsuit to try to have clarity. So I would say that the IRS is doing better than many of the other agencies in releasing guidance.
Yeah, the SEC seems to love their regulation by enforcement point of departure. So, uh, talking about airdrops, this is something that I've been curious about. It's pretty clear, right? You're taxed on the amount, you're taxed on the value of the tokens at the time they drop into your wallet. Let's say the token tanks. From what I understand, you can do a tax harvest at the end of the year, sell that token, and rebuy it, and that should neutralize your whatever you owed. Like if let's say a token is airdropped at $1,000, and then it goes to zero. Do you owe any taxes?
No, can you hear me? I think my headphones went out for a second. Can you hear me okay? Okay. Yeah. Awesome.
Yeah,
Cool.
I can hear
Okay.
you now. Yep.
So let's walk through that scenario. And that is kind of getting into the nitty-gritty details, but I think that it's very important because it's one of the big mistakes that we see clients make all the time. So say you got an airdrop. Maybe you were a Bored Ape holder and you receive a Mutant Ape or maybe just ape coins, whatever it may be. And you receive this airdrop and it's worth $10,000 at the time that you receive it. You now have income of $10,000. Let's say 6 months later, the price of it has dropped to $1,000. ApeCoin's trading much lower. It's worth $1,000. You now sell all of your ApeCoin. You now have a $9,000 loss. You had it originally at 10,000. You reported income at 10,000. Then you sold it for 1,000. $9,000 loss. But from a tax perspective, we have two separate events. We have income, $10,000. Then we have capital loss, 9,000. Everything sounds groovy, but the reality is that capital losses can only offset income up to $3,000 a year. Capital losses can offset capital gains an unlimited amount each year, and I'll talk a little bit about that. But if it's with respect to income, that's only $3,000 a year. So in our example where you have 10,000 of income and then you sell it for 1,000, meaning a $9,000 loss, you can only actually take 3,000 of the loss. So you're going to pay tax on $7,000, even though you've got $1,000 of cash in your pocket.
Make that makes. I mean that I hear that, and it just, how does that make any sense? All right, like that. How is that? Sorry. Go ahead, Andrew. I didn't mean to interrupt
No,
you. I just
please.
I don't understand how someone can be taxed on something that is not worth anything.
Yeah, no, and I'm with you. And it's because the tax code separates out the capital gains, capital losses versus income. If you had capital gains, you were trading and you had 10,000 of gains and then you had 10,000 of losses, they can offset one another completely. But because the IRS sees income and capital gains differently, they say that you only get 3,000 a year. I didn't make this rule. I think it's a pretty bad one, but the effect is very important because if you're out there trading or you're receiving airdrops or forks, or you're even staking, and we could talk about that, or receiving income, you have to be very aware of the tax consequences then, because even if the price drops, you may not be able to offset that income with your losses. So yeah, no, I agree. It's a very unusual situation.
Hmm. Okay, so I want to get a bit more nuanced. Let's say that you received an airdrop. Let's say you received a Uniswap airdrop in 2020, I believe it was, and it was on an old wallet, and you had no idea, right? It's just sitting there, and you realize, you know, years later that, oh shit, I can go and claim this airdrop, or I already claimed it. Sorry, I can go and claim this airdrop, or I don't have to claim it. It was the tokens are in my wallet. How do you go back and make sure that you pay taxes on that for the year that you were supposed to pay taxes on it, and then obviously if you cash it out, then you have to pay taxes for the current year as well? Hope that makes
Yeah,
sense.
absolutely. And I guess more generically, you might be listening to this and think, oh, shoot, I had crypto taxable events, be it an airdrop or even trades in the past, and I didn't report them. Um, in most situations, it makes sense to go back and amend those taxes, especially if it was 2020 or 2021 in a very recent year, and report that income. The process of amendment is fairly simple. And in our experience, it actually reduces the likelihood that the IRS is going to come to you or audit you. Because the IRS is getting a ton of this information and data, and to connect the dots for them reduces that likelihood. So by going back, reporting it on your tax return, the IRS knows about a lot of these airdrops and forks that have occurred. Hopefully, you'll avoid audit. But not only that, you'll report the income, so you'll owe a little bit of tax, but that'll set your cost basis going forward. So then later when you sell it, your gain is your cost basis, or I'm sorry, your sales price minus your cost basis. And if you didn't report it, so option one is go back and amend, and that's our suggested route. Option two is you don't go back and amend. And if you take that approach, when you sell it later on, the entire price will be a capital gain. You've got no cost basis to offset. But making it even a little bit worse, it might be hard to argue that it's long term rather than short term. And I'll talk about that next. Because if you never reported it on your tax return when you got it, the IRS may think that it paired out of thin air this year. And so now it's short term gain when it could have been a long term. And that's important because one of the best tax strategies out there is holding for long term versus short term, holding for greater than a year. Why? The tax rate is about half the tax rate of if you sold within 1 year. So you can cut your taxes in about half by waiting. The tax rate on a long-term sale is typically 15 or 20%. The tax rate on a short-term sale can be up to 37%. So by knowing what you're holding, when you acquired it, and having a strategy as to what you're going to sell and when, you can impact taxes substantially and save a bunch of money.
Yeah, I've heard for a while that holding long-term is the way to go. I mean, I'm personally a long-term holder. I've never sold any Bitcoin or Ethereum, but I do know people that day trade, and those, those short-term capital gains really crush. I know a lot of those folks actually end up moving to places like Dubai where they can trade freely. I think up to 100K, if I'm not mistaken, before they have to pay taxes. Andrew?
Yeah, I'm not sure in Dubai, but for instance, we've got a lot of clients that have relocated to Puerto Rico. Um,
I think Andrew might cut out.
oh, can you hear me now? Sorry,
Yeah.
my AirPods for some reason keep going in and out, but I think they're okay now.
Oh yeah, man. I don't ever use AirPods with spaces. It's super buggy.
Next time I know.
Experience.
Well, thanks, thanks for letting me know. I'm sorry. Can you repeat the question again, Noah?
Yeah, of course. So, and I don't want to talk about the tax laws in Dubai. I'm just saying that I know that there's no capital gains from crypto Dubai, but from what I understand about the U.S. tax law, even if you're a U.S. citizen working in another country or living in another country, you still have to pay taxes after a certain
Absolutely.
number. And I was curious about what that number is. I used to think it was 100,000, but it could be more now.
So as a U.S. person, you're taxed on a worldwide basis. It doesn't matter if you live in Antarctica and work in Antarctica. If you are a U.S. citizen or a U.S. person, the IRS wants their cut. Sounds really crazy. It's the way it goes. There's only about a handful of countries that tax this way. Most tax while you're within their borders, not the U.S. Your tax doesn't matter where you live. But there is some exceptions to that. There is what's referred to as the earned income exclusion. And this is a kind of a tax break that the government has given you, that if you live outside the US 330 days out of the year, 330 days, so that only leaves 35 days to be in the US, then you can exclude up to about $100,000 of income from your taxes. And then the rest is taxed. But that's really just for the people that are outside the US the entire time. What we've seen a lot of people do recently is move to Puerto Rico. You might see a lot of crypto Web3 people in Puerto Rico, and that's because of the tax benefits. Puerto Rico has a very unique deal with the IRS and the US government as a territory. And so if you live there half the year, 180 days or more, then you will have a 4% tax rate on income and 0 on capital gains. And you still get to keep your U.S. citizenship and all of that fun stuff. But you got to live in Puerto Rico. I thought it was too good to be true when I first heard it, but we've had clients there for, I want to say, about 5 years now, taking advantage of it every year without issue.
Andrew, for clients that are serious about doing something like that, do you guys offer consulting services on exactly how that plan goes from A to Z?
We can help from A to Z, from discussing whether or not it makes sense and analyzing what the tax effects would be, to also helping with the Puerto Rico, it's called Act 60 application. We've helped many, many clients over the years go through that process and have been very successful in doing so.
I want to go back to the airdrop example because I think it's really interesting and I think it can get pretty nuanced, pretty fast. You brought it up earlier. You said sometimes people get an airdrop and they don't want it. And so let's say that, let's say I don't like someone. Acti's on the Whalecoin Talk account. Let's say I don't like Acti, and I make a token and I set its market value at like $100,000, and I airdrop it to Acti, and then I tank the token. And now Acti owes $100,000 in airdrop money, but he can only harvest, I think, $3,000, as you said, as a loss off that. Like, what is he supposed to do?
Yeah, that's a great question. If it's someone doing like an attack like that, that may be a different situation, right? Where it's like you're directly targeting someone and dropping them to screw up their tax. Maybe a different situation. I haven't had that, but what I have seen many times is maybe there's an airdrop for a project that you just don't like, or like there are some that are even just pretty nasty. The projects, you're like, I don't want this token. I want nothing to do with this project. The IRS code doesn't necessarily speak to that exactly. What the code would say is it's still income to you at the fair market value. It doesn't matter if you were doing construction in your house and opened a wall and found gold, or there was a briefcase of money that arrived on your steps. And these are cases that the IRS has actually had. That is income to you. Taking that even a further step, and this is one of my favorite examples, home run baseballs. In the 90s, early 2000s, there's all these like home run competitions, and Sammy Sosa, Mark McGwire hitting all these home runs, and these baseballs became very valuable. In fact, some of these baseballs were worth over $1 million a piece. And the IRS, Congress was actually quite clear during this time that if you caught one, that's income at the fair market value. And so, of course, what happened is someone caught one that I think it was a Cubs game, hated the Cubs, wanted to destroy it, wanted to donate it and have a big ceremony where people watched and the ball was destroyed. But what they found out was that it was worth a lot of money, and that even if they destroyed it, they would not have the ability to offset that income. And similarly, even if they made a charitable deduction, still have the income. And the reason I bring this up is because baseball is America's game. And if Congress and the IRS were going to treat baseball so negatively, it's hard to think that they're going to give much leeway to crypto. But with all that said, if you receive an airdrop and you absolutely don't want it, you can show that you've abandoned it. You maybe sent it to a burn address, something like that. We are comfortable taking the position for our clients that it was never received, that it was immediately abandoned. But that is kind of a gray area. And if you look to the cases about baseballs, funny how that all works, it would be actually a pretty difficult argument to make. And they would say that even if you didn't want that baseball, if you caught it, you've got the income.
Man, even with America's favorite pastime, the IRS does not care. So that's like the second most unfair thing, I think, that you, in my opinion, unfair thing that you've said on here. I think the
Well,
first
thank you,
most
Noah.
unfair thing is
That means a lot to me.
I think the first most unfair thing you share with us is like the whole only, if I get an airdrop and it tanks, I can only write off 3,000 of that. It's like, do you have any hopes that, you said that the IRS has done relative to its SEC counterpart, has done a great job with building out a regulatory framework for crypto. Do you think, well, I think that it has more room for improvement. And do you think that it'll start to see more and more reforms over the next few years and have some of this stuff make more sense?
So definitely room for improvement. I think there's several areas that don't make sense, like, the one on capital losses. Also, one that probably hits close to home for a lot of people is Celsius, FTX, BlockFi, Voyager, and how people have had tokens that were lost there, either locked up, part of bankruptcy, and likely to never be able to get them again. Also, people that use those platforms had taxable interest. Some of them were getting rewards, and they have even issued 1099 forms to people saying, hey, you received $10,000 of rewards last year. You owe taxes on it. And that's incredibly negative. And I do hope, and I'm optimistic, that the IRS or Congress in the next few months will give a little bit of a reprieve towards those that had holdings on these platforms. Because as of now, the code states that you could only take a loss when it's known and complete, when it's certain and complete. And we don't have that yet because these cases are in bankruptcy. And what we've seen is sometimes even in bankruptcy, you get small recoveries. So taxpayers have lost their holdings. Sometimes they even owe tax on the interest. And right now, there's no way for a loss. But in the past, the IRS has stepped in after the Madoff Ponzi scheme. The IRS stepped up to the plate and said, "Hey, we're going to make a Ponzi deduction." So I'm hopeful that because the news says FTX is bigger than Madoff, that they'll do something here. But I think that that's one example that hopefully in the short term, the IRS, Congress, Treasury issue some new regulations. But overall, yes, I do think that it's an area that's going to continue to develop because the IRS wants people to self-report. They want people to pay taxes on their own. They don't want to have to audit everyone. And you can't self-report if you don't know the rules or if they're not clear.
Absolutely. So if you receive, for example, salary, but you're receiving it in ETH and the price of ETH tanks, does that same rule apply, right? You can only write off is receive or actually let me rephrase the question. Is receiving salary taxed the same way as receiving an airdrop, where if the price of the asset drops, you can only write off X amount of it, in this case 3,000?
Yes. So say you're working for a project, you're paid in ETH, and that ETH is $50,000 when you're paid. You have income now of $50,000. And then 2 months later, the price of ETH drops in half. And that's only worth 25,000, and you sell it all. You will still have income of 50, and then you'll have a $25,000 capital loss. But capital losses only offset income up to 3,000 a year. So you'll have 47,000 of income. Gross shit, choose your curse word, nasty stuff. So what do you do? The advice that we give clients is that if you are paid in a non-stable coin, something like Ethereum or Bitcoin, as soon as you receive it, make some decisions. The most aggressive being that you just hold it. You're speculating entirely. You're going to gamble on the entire value and your tax. That's the most aggressive. The other middle ground would be to sell enough of it to stable or cash just to cover your taxes. So you get paid 50,000 of ETH, maybe you sell 30% of it so that you've got your taxes covered, even if it tanks, even if it gets cut in half or it goes to zero. And the most conservative option being if you get paid in a variable currency like Ethereum, convert it all to stable as soon as you receive it, because that way you're not speculating. In the eyes of the IRS, as soon as you receive it, you've got that income, and then you make the decision as to whether or not you want to gamble on the price going up or down, but the IRS is not going to make that gamble with you.
So if your clients have the option of receiving income in stable or something variable, would you typically advise them to take the income in stable instead?
So it's completely an investment decision, right? So if you believe in Ethereum, you think it's going up, then you want, it in Ethereum. But I would suggest that in that case, sell a portion, perhaps 30%, something like that, to cover the tax. But it all depends on your investment thesis. If you don't care about Ethereum, then yeah, sell to a stable because that way you know the value and you won't have the potential negative effect where if the price goes down, you still owe tax either way.
So moving on, Andrew, was curious about gifts, right? What if someone receives a gift in crypto from an individual? Well, let's paint two scenarios. An individual in the United States is sending a gift to someone in the United States, and then an individual outside of the United States is also sending a gift to the United States. Like, how are those taxed?
Um,
Think we might have lost you again there, Andrew.
you got me now? Hey, do you have me now? Noah?
Yes.
Awesome.
Yes.
Okay.
Yep, you're back.
I'm taking off the AirPods. Forget the AirPods. Okay. So, in the US, gifts are one of the few things that are not taxed to either the recipient or the person that is giving the gift. But there are some exceptions. If you are giving a gift over $16,000 in value during the year, then you have to file a gift tax return. The person giving the gift has to file a gift tax return. During your lifetime, under current law, you can gift up to $10 million dollars and some change without tax. And so this gift tax return shows the IRS, okay, I've given a gift this year of this amount. It's reduced my $10 million. Dollars. This is how much I have left to give in the future, but I'm not being taxed now. And that's for the person giving the gift if it's over 16,000. If it's under 16,000 per year, nothing to do, nothing to report to the IRS. If you're the recipient of a gift, it is not taxable to you. It's not like income, right? We talked about airdrops, forks, payments, all these things. Income, income, income. Gifts are not. It's not taxable. But one of the most important things is to get a gift letter. Get a letter from the person that gave you the gift that says, this is a gift. This is 5 Bitcoin given to you on this date. It's not payment for services. It's gratuitous out of the goodness of my heart. And the last important piece is the person who gave it, their cost basis, and also their date of acquisition. So if they bought it, if the person bought it a year ago and then gave it to you today, they should communicate to you in that letter what was the date that they gave it to you. I'm sorry, the date that they bought it, and then what was the price that they bought it for. Why is this important? Because then that information can be used on your taxes, and you can, in most situations, take their cost basis. It's a great, great effect. You could take their cost basis, so when you sell it, you have less of a gain or less tax to pay. So $16,000 is the magic number, but in any case, you should get a letter that describes the gift.
Mm-hmm. And Andrew, what about in the second scenario where the person gifting is outside of the United States and doesn't have to adhere to our tax laws?
So if you receive a gift from someone that's a non-U.S. person, non-citizen, you typically the same rules. The recipient, nothing to do unless the gift is over $100,000 in value. If you are a U.S. person that gets a gift over 100K in value from a non-U.S. person, you have to disclose it to the IRS. There's a tax form that you have to file and show or disclose who gave you the gift, how much was it, what is the date. That's over 100,000 in value. So before we talked about the gift tax return being filed by the person that gives the gift, that's if it's over 16K in the US. But if you receive a gift over 100K from a non-US person, then there's forms you have to fill out. And when I'm talking about value, I'm talking about the actual spot value, the fair market value at the time of the gift, not what it was worth originally, not what it was worth a month ago, but at the time of the gift.
Okay, that's really interesting. I didn't know that. I didn't know that under 100K, or in the case of a US person under 16K, was non-reportable. I thought you always had to report you always have to report a gift. But you also said it's important to note when that gift was sent, and or that person sends you like a letter or something saying, hey, this is a gift sent on this date for this amount and I'm not getting anything in return, correct?
Correct, because if the IRS audits you, for instance, they may see Bitcoin coming into your wallet. And naturally, they'd assume, okay, this is income. You received payment, right? You got Bitcoin. The way to counter that would be evidenced through a gift letter of no, this is an income, this is a gift. Now, without that letter, people say all the time, nah, that wasn't payment, that was a gift. But without proof, that's very hard to support. The letter supports number one, that it's a gift, but also allows you to take their cost basis and their holding period and use that as your own. And without that information in a letter, you wouldn't have it.
Okay, right on. I guess that's all the questions I had with respect to like salaries and airdrops. I'm assuming a lot of these same laws can be applied to people that play Web3 games and earn whatever native token they are playing. I mean, it seems like it's pretty much the same, correct?
Yep, you got it. So if it's a Web3 play to earn game where you're earning something of value, and especially if that can be converted or traded or taken off the platform, that is in many cases income, and typically the trades are taxable events too. The fact that it's occurring in a game, if you could take it out, doesn't really matter. It's still taxable events.
Okay, got it. Um, so Andrew, I'm curious to know, based on everything that you've shared with us and all your wide array of experience, what do you think needs to change for um, one, people that are not reporting to be more open to reporting their crypto? Because I feel like a lot of people just fly under the radar and they're like, I'm a small fry. Um, what do you think needs to happen for more people to self-report like the IRS wants? And what do you think the IRS needs to do to really improve the kind of the clarity around crypto taxes?
So yeah, those are great questions. I think there are some regulatory changes that could, number one, increase adoption, which unfortunately I don't think the government cares too much about, but also increase self-reporting and just accuracy. One of those changes could be to have a de minimis law, where trades under a certain dollar amount don't need to be reported. For example, if you buy a cup of coffee with Bitcoin, that's a taxable event. You're going to need to calculate your gain loss, and you're going to have to report that on your taxes. Not great for adoption, also not great for compliance because you're making a big headache for all the little trades. So some countries like Germany, for instance, have a de minimis law where unless the trade reaches a certain value, it doesn't need to be reported on your taxes. $100, couple $100, whatever that may be. That way, we're just focusing on the big items, and we're not drained with transactions to have to work through. And that kind of gets to my second point, which is better resources out there. There are a lot of crypto tax software companies out there, and many of them are great. But for users that are in Web3, NFTs, doing complex transactions, a lot of the software kind of fails. And then you'll need a professional like us to be involved. So hopefully over time, the software steps up as well. I think the third and final change would be towards staking and airdrops, and there have been some efforts in this area to have it not taxed until it's sold. So if you receive an airdrop or staking rewards, you don't get taxed right then and there, but only when it's sold. That is not the law now, but there are some efforts to change it to do that. And if we move towards that, I think we'd be at the forefront of proof of stake, for instance, as a country. Versus now people that have the issue that we talked about, where if you're staking, you earn rewards, you owe tax at that fair market value at that time, and then it drops in price. All right, that sucks. That's horrible. That's not great for growing, proof of stake in the industry as a whole. Because as soon as if you're staking, you got to pay tax. Okay, now I've got to redeem some to pay the tax. Um, some industries, farming, mining, like the actual mining out of mountains for minerals, fishing, things like that, you're only taxed when it's actually sold. There are differences with crypto, so the analogy doesn't fit exactly, but there are examples where you're only taxed when it's sold, not when it's received. So I think those changes would all help.
I almost skipped over a question. It was about people that yield farm or are getting staking rewards, but have to claim those staking rewards from the contract into their wallet. Um, does are they taxed just uh, are they taxed as they are earning those rewards, or are they taxed as soon as they claim?
Great question, and one that the IRS has not been explicit on, but most practitioners feel pretty confident about the answer. And the answer that we is that it is taxable as soon as you can claim it, as soon as they are earned, not as soon as you claim it. And this follows a lot of other examples that the IRS has, where basically if you earn something, if you've got dominion and control, even though you may not have custody at this point, it's yours. And we think it would be very unlikely that the IRS would let people manipulate the amount of income or gains by just waiting until the price goes down and then claiming that day. Or if they claimed on a day where it's high, be penalized. Instead, we think the code would answer with is that as soon as you can claim or they are redeemable, that's when the event occurs.
Got it. Do you guys also give legal counsel to folks who are running Bitcoin mining operations, or maybe they're running a fat Ethereum node and have a bunch of ETH being staked to their validator? Do you guys set up plans and ways for them to pay taxes, and like how does that really work with the prices of these two assets fluctuating so much?
Yeah, absolutely. We help clients not only with the tax reporting, so actually calculating gain, loss, and income and generating those forms, but we also help clients with setting up businesses or evaluating whether or not they should set up a business, and then also tax planning. If you are receiving rewards or being paid, having a tax plan, knowing how much you're going to sell, when you're going to sell, what those effects are, is very helpful. And yes, we help clients with all of those things all the time. We have many clients that are miners, validators, node operators. We're very familiar with the space in terms of the deductions and the things that can be taken. And we can also help with all of the tax compliance requirements.
Andrew, how do we get in? I don't know where you guys are based, but how do American citizens get in touch with you? Hire you guys for their services? How many people do you have working for you? What would be the process?
So we are based in Chicago, in the suburbs of Chicago, but we help clients throughout the world. It has to be U.S. taxes. Right? We don't know the taxes of Portugal, but we do help people throughout the world. So feel free to reach out to us on Twitter. This is my personal account. Also, our company account is at GordonLaw.Ltd. You can find us online at GordonLaw.eth or GordonLaw.com. Our website, GordonLaw.com, has a ton of resources on crypto. If you didn't catch all the different things I talked about here, we've got guides. We constantly release blogs and articles. So just a ton of free information on the wonderful and exciting topic of crypto tax.
And have you thought about setting up infrastructure on the chain? Oh, sorry, excuse me. Have you thought about setting up infrastructure on chain for people to hire legal services? I had an attorney on a couple weeks ago, and he is selling services by NFTifying them. Like you can buy a different tier of NFT, and that tier of NFT will get you access to like X, Y, and Z legal services. Have you ever thought about doing something or going that approach to maybe capture some of that NFT degen community?
So about a year ago, we released a tax guide, an NFT tax guide as an NFT. It's available on OpenSea, and by buying it, it also includes a tax guide and discounts to crypto tax software. So yes, we have tried those things, and yeah, certainly open to them in the future. As always, what we're focused on is making sure that we're using the technology for an actual value add rather than just saying that we've got an NFT. But yeah, definitely something that we're open to considering and continue to evaluate.
If there are any Americans in the audience that have a question, feel free to come up. But I think, Andrew, those are all my questions, at least the ones that I had in my head and I'd written down. Is there anything that we might have grazed over? I know tax law is super complex, and we can probably talk about this for days. But is there anything that I might have might be grazed over or skipped, or we didn't cover that you think is important to highlight?
Well, that's a tough question because there's always more to talk about with tax. But one important thing, I guess, in closing is if you're hearing all this and not only are you concerned about potentially amending prior years, but are just concerned that you might owe the IRS a bunch of money in crypto taxes, especially after the bull run in 2021 and then the slowdown in 2022. If you're concerned that you owe a bunch of taxes and you don't know how you're going to be able to pay or you don't want to pay, what I would say is the most important thing is filing and filing accurately. Believe it or not, the IRS will grant a lot of leeway when it comes to payments. We help our clients on a regular basis get payment plans, typically over 6 years. And as long as you're paying monthly, the IRS leaves you alone, typically doesn't impact your credit. Everything is groovy. And this is important because we get people all the time that say, well, shoot, based on this tax bill and the value of crypto today, I've got to liquidate everything. And this provides an option. This way, you don't have to liquidate everything. You just have to liquidate enough to pay the monthly payments, but it gives you time. And I think we're all hoping that the market's going to correct. It's going to go to the moon, Bitcoin to 100K. And obviously, you've got to make your own investment decisions, but it provides those options for you so that you don't have to. And it's much better to report accurately, report in full, than get a payment plan than just ignore it overall. What will happen is probably penalties, interest, and even worse, rather than just using the systems that are available to your benefit.
Mm-hmm. While you were breaking that down, Andrew, I had another nuanced question pop up in my head. I was thinking about those like crazy. There was a time when there was like quick, crazy 10 million APY tokens were all the rage. We had several come on for AMAs back in the day, and I was wondering how those are taxed, right? People that just, I think, I think it was like Titano or something. Acty, I can't remember, but
And there's
you
like
just like,
Safe Moon also. Yeah, there's several of those. Yep, I'm with you. And the tax code is pretty clear on this. It's what we've talked about this entire time, which is if there's income received, even if it's 1,000 APY, if you received it at that time, you could have traded it right then and there, you've got a taxable event. And that really sucks because a lot of these turned out to be crap and the value tanked. And we talked about the effect of capital losses. But yeah, it just goes to show tax planning in the beginning can be very helpful because we would have advised at that point, sell just a portion of your 1,000% APY to cover your taxes and speculate on the rest if you so choose.
interesting, because it's like if you, let's say you bought one of these things at $100 and then it went up to 5,000, and it's compounding like every, I don't know, these epochs are like it's compounding like once every 6 hours or something. That it becomes super complicated. No, it's just compounding every 6 hours for like 10 months, and the price is like shooting up and down and up and down. Like, do you just have to use some sort of proprietary tax tax calculating program to actually figure out how much one owes on that?
Yeah. So we use a number of the off-the-shelf crypto tax software available, but many of the different new protocols or chains that have these massive yields, or we're seeing rebasing, or all these other things. It breaks the software. So we have to do a lot of it manually, or we've developed scripts to help us with a lot of these as well.
Any off the shelf software that you recommend to folks?
So the ones that we work most closely with are ZenLedger.io and CoinLedger.
Right on. Well, I don't think anyone in the audience has any questions. I learned a lot, and I really appreciate you coming on here, Andrew, and dropping knowledge on us. I hope that the clarity you provided gives people maybe a sigh of relief if they forgot to report back in like 2015 or something. They can always amend, and you said that the IRS likes it when people amend because and figures out a payment plan. There's actually ways to do that through your firm at GordonLaw.eth. So let me know if I missed anything, but if you want to leave our audience with some last words before you head out today, go ahead and do so now.
Well, thank you very much. This was a lot of fun. I know taxes are not always the sexiest topic around, but they are a large part of the equation. So being aware of taxes can help you all substantially. Please feel free to reach out to me on social media or email or on the phone. There are phones nowadays still too. If you have any questions, we are happy to help or have a consultation to talk about your situation. But thank you very much for having me. This was great.
Yeah, my pleasure. Thank you, Andrew. Whale community, you're listening to another episode of The Aquarium with GordonLaw.eth. My name is Noah, and remember that everything you hear on these broadcasts is meant for educational purposes only. Nothing is financial advice, so be safe out there, and we will see you all in about an hour for the third AMA of today, at least the third one hosted by me. Chat soon. Bye-bye.